Übertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
So, hello and good afternoon. I welcome everyone here to the weekly market outlook for Admiral Markets. My name is Klatt and I'll be the moderator here for the upcoming around 45 minutes. We want to have a look at the events of the upcoming week of trading. Sure, we also want to have a look at what happened over the last days, and we probably will also try to answer the question, what just happened in the DAX? Some of you probably have seen this. Yeah, in my opinion, it's a squeeze on the upside. This massive move, let's put it that way first. I want to be honest with you. I got completely caught on the wrong foot. That doesn't mean that I paid and I lost money, but I didn't make money either. So how can you get a better idea of that? So my trading system would have generated a long signal in the DAX this morning, and I skipped this long signal because my bias was short. So I have a trading approach where I let a system generate the signals, but nevertheless I have the power to overrule those signals here, and this is what I call a discretionary intervention. And so I didn't lose money because I'm not positioned in the DAX, but I didn't make money either, which is nearly as bad as losing money, probably even worse, because it feels just horrible, because you know that the system would have been long and you only had to trade the signal here. And so, yeah, this is a perfect example of being caught on the wrong foot. And sure, my mind, it's not that it's racing right now, but nevertheless, I wonder what's going on. We want to try to give an explanation for this. So I have an idea what could have happened, because today is a small expiration on the Eurex and the FDAX. And after yesterday, with the retail sales data and the drop below or towards 11,100, slightly below 11,100 points here, probably this has something to do with it. But let's just see. At the end, it stays the same. So I'm not positioned. I didn't make any money. I didn't lose. Okay, cool. But I didn't make money either, which is not really cool, to be honest. So but before we want to start, first we have to have a look here at the risk disclaimer. Very important to note that trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. For further information on this risk disclaimer, feel free to reach out directly to Admiral or visit, for the risk disclaimer, the webpage, admiralmarkets.com. What we want to have a look at here is surely the differentiation now between retail clients and professional clients again, the so-called ESMA decision, which is which is in play. I don't know if this is the right word for this, but since August we have a reduction in the leverage for retail clients, and professional clients do not face this reduction of the max leverage they are offered. So in this context, we have to note that now there's a leverage restriction for retail clients with a max of 1 to 30 for Forex majors like Euro USD, for example, dollar JPY, while other currency pairs have a max leverage of 1 to 20. This is like cross pairs, like let's say pound Australian dollar, for example. And CFDs like the DAX, for example, or gold also have a leverage cap at 1 to 20. As already said, professional clients do not face this leverage restriction, so they are still allowed to trade with a leverage of up to 1 to 500. What's of high interest, especially for retail clients in this context, is that they also have an unlimited protection against negative balances. And now the offering from Admiral Markets here for their professional clients, they have also, professional clients also have a negative balance protection up to £50,000 according to their policy. Further information, please feel free to reach out to Admiral, therefore, directly. This is me. This is the face to the voice you're currently listening to. And so I said already good afternoon, which indicates that here right now it's around noon to afternoon, in fact. So I'm located in Berlin, Germany. Admiral Markets also has, by the way, an office here in Germany, in Berlin. But nevertheless, it's an international webinar, so probably you're listening here from Auckland, New Zealand, for whatever reason, and sitting during the night in front of your screen. But the question probably arises, why Admiral Markets, and why do I mention Germany here especially? Because here in Germany, we refer to Admiral Markets as the so-called DAX expert. So Admiral is offering has one of the most competitive DAX 30 offerings here in the industry, with a typical spread of 0.8 points during the main trading hours. Also very competitive in terms of FX. For further information on the offering from Admiral, feel free to reach out to the website and or contact Admiral directly. So we are located, or I am located in Berlin, as is, for example, one office of Admiral Markets, but it's a global company acting on a global scale here, with also, for example, offices in Chile or also in Australia, having different licenses then and regulations which apply also here. Feel free for further information on this to contact Admiral directly. Here are the contact details. And then we want to have a look here at the current, or not at the current, at our agenda for today. Even though it's a very, very general one, we'll dig into the details then, especially around the DAX in a few minutes. So we want to answer the questions. What are the key economic events in the coming week of trading? Very interesting, because all in all, we have to say it's in fact not 5 days of trading next week, but it's only 4. On Monday, we have President's Day in the US. It's a bank holiday. And that said, there's also a change in the trading hours then. I will show you where do you find those changed trading hours then, even though it's just shortened trading hours, which means in case of, for example, the Dow Jones or the S&P, for example, so US indices here, you can trade them till 6 p.m. London on Monday, while, for example, the DAX can be traded till the end of the day, which means 21 London. Nevertheless, the thing is that the DAX highly depends on the liquidity and moves from US equity markets. So if there's no moves happening, well, you should not expect big moves to come in the DAX here too. But this is only one day. We want to have a look at the other economic events then shortly after, in a few minutes here. We want to answer the question, what's the current bias in the FX, equity, and commodity markets? Probably especially after yesterday in the retail sales. And when looking not only at the DAX right now, where one would probably say, hey, if we see such a really sharp squeeze, a parabolic move higher on the intraday time frame, is there really something like risk off? Well, I'm not sure whether we can really talk about risk off right now, but nevertheless, when looking at gold, for example, or the JPY, we can see that both are up for the day, which is usually an indication of some skepticism, at least brewing. And this indicates that we should be really, really careful to overestimate this push higher in the DAX and don't see any risks on the downside anymore. And also, sure, we want to answer the question, which trading opportunities may arise? And then we switch over here to the DAX, this is the S&P in fact, but we want to switch over here to the 5-minute DAX in this case, so that you get an idea of what I'm talking about. So you can see here, we started the day, in fact, neutral, with a slight push lower, and here, that was the moment when I thought, okay, probably now we get to see the push towards 11,000 points. It's not that 11,000 points in the DAX has, or had, still has and had a few hours earlier high significance. But from a psychological perspective, I consider 11,000 to be an important level, to be honest. And I was thinking, and that was my intention, to skip the long trade in this case, that once we break below 11,000 points, which is here, this dotted green line here, that we have further room on the downside, which could easily push us down to the lows, which we marked 1 week ago on Friday, around 10,860 points. So I was really, really skeptical, especially after this big drop yesterday, so nothing really happened. And so it's definitely possible right here to say the main driver for the bearish action yesterday in the DAX was initiated by the retail sales from the US, which came in significantly below expectation with minus 1.2%. That was, by the way, the biggest disappointment since September 2009, if I'm not mistaken. We want to have a look at the chart here in a few seconds. And so the thing is that this was surely the trigger which then pushed the DAX lower and which pushed it below an intraday level which was of interest for me, 11,100 to 11,130 points. The thing was that the DAX really couldn't catch a bid then, also not during the US main trading hours then, but pushed lower and fell towards the region of 11,000 points, which was, in my opinion, a very, very weak sign. And we're looking at the dominator of the hourly chart. We can also see that all in all, it was, in my opinion, at least only a question of time since such a sharper drop would happen, since this corrective move from the December lows here looks a little extended. So now the question arises, and this is something which now caught my attention after this happened yesterday. I hadn't it on the agenda, to be honest, for today. And even if I had, by the way, I think I would have skipped this long trade. So the question arises, where is this pressure coming from? So as I already said, the initiator most likely were the retail sales yesterday. But the question is more, where is this push then coming from? So is the market really, was it capable of building such a huge short position within such a short period of time that it could result in then such a sharp short squeeze? And by the way, what just happened? I mean, nothing really happened overnight. Only that Donald Trump avoided a second shutdown by agreeing to a deal in terms of the border, which is now not really a border anymore. We don't want to dig into too many details here because I have to say that these shutdown stories, let's say, they did not affect the market at all. Over the last weeks, and it nearly lasted the whole month of January. And instead of sharply dropping and the market really fearing probably downgrading of the US credit debt, for example, which could have led then, by the way, to another wave of selling due to investment banks, for example, having to reduce their leverage on their equity exposure. Even further. I think they already started to do so. I haven't prepared a chart here, but I could deliver a chart right now. But let me just get these thoughts, finalize these thoughts here. So nothing really happened around this shutdown. So I have to say this, even though some of you probably will hear something in the media about the push higher in the DAX then, or also in US equities probably, if it happens, depends on what we get to see then in the upcoming hours. But probably it's due to this agreement around the shutdown. I have to say this is something which is far away from what I think happened here, because it didn't bother the markets over the month of January. So why should it bother right now if finally a solution is found? So what could have happened instead? So therefore, and knowing that today is the third Friday of the month, in the DAX, or in the FDAX in this case, so in the future DAX, at the Eurex, every third Friday of the month, we have an expiration. Every March, June, September, and December, it's a big expiration. We know this. This is also something we know from US equity markets, for example. We call this triple witching. But nevertheless, those small expirations sometimes also play a role. The interesting thing about this is, by the way, that someone mentioned it in the morning in a conversation I had, and I just said, yes, today is the small expiration, but does it really affect the markets right now? So when looking at the current action in the DAX and not finding any potential drivers for this push higher here, it's probably not such a bad idea to look over at this expiration. And therefore, we have to dig a little deeper. Nevertheless, sometimes I think this could be worth it, and for the future, be of interest for you to get a better idea of where bigger moves come from if no real trigger event, like yesterday, for example, the retail sales as the main initiator, and we saw some very volatile price action till 1:30 p.m. London here, and then there was a sharp drop occurring after those retail sales data came in. So what we want to do is we want to have a look here at the so-called open interest of options being written on the FDAX here, and here we want to have a look at the short puts, not the short calls, but we want to have a look at the short puts here because yesterday there was a sharper drop lower. So what do I want to do is the following, or what do I have here is it's from the website of the Eurex. So the link here. So if you click here on the English version, usually you should get the market statistic data here too. So I copy it and then, okay, this is, to be honest, this is not cool because it's not delivering. It's not delivering what I want to see here, to be honest. Or let me just see what happens here. No, nothing happens. Let me just see whether so it's online market stats. Let me just see. So I mean, it's self-explaining in German too because we are only looking at the numbers and they're not different. They're not different from the data in English, but nevertheless, it would probably be better if you have information on this in English. No, you haven't. Okay. Well. Okay, then let's just have a look here. So you can find this by Googling DAX, Eurex, and then options. Just look it up in Google, and usually you should be forwarded to the page here, which I present to you. And then you scroll to the bottom of it, and there at the bottom, you have a chance then to see short calls and short puts on the ODAX in this case. So, and here, yeah, well, we have the DAX puts then in this case. And why do we look at the puts? Because yesterday it was a move on the downside, and puts are usually looking at the downside. The interesting thing about this is, nevertheless, and that's worth note, or this is noteworthy here in this context, we are looking at those market participants who got caught on the wrong side yesterday. So let me just here make a snapshot, and then what we have here is the so-called strike price. So it's ST, and here is the OI, which is the open interest in this case. So, and yesterday we have to remember which levels were broken here. It was 11,200. That was the first one, and then we also dropped below 11,100 points and shortly stopped here today in the morning above 11,000 points. So just look up those numbers in the hourly chart, and you will see that we started here around 11,200 points yesterday, and then there was a sharp push lower, and then another push which brought us below 11,100 points also here. So we closed around 11,100. So probably it's more interesting to only have to look at here 11,200, but at the end it doesn't really matter. What's of interest is we have to have a look now what level is of interest for market participants. We want to answer why it is of interest in a few seconds, but first of all, where is the highest interest? And therefore, this open interest comes into play, so the right column in this case. And what you can see here at 11,200 is that it has the highest open interest. I mean, sure, it's a slightly higher open interest at 11,000 points, but it's the highest open interest here at on 11,200. 11,000. The reason for that is most likely because it's a psychological relevant number. That's one of the reasons, by the way, why I look at those round numbers. It has to do with the fact that I know from experience that this is usually the level where the highest open interest can be found. But yesterday, in our case, it was 11,200. It was the highest open interest here. So this is data from overnight, but you can see here in this case that there was a quite high a volume traded on this level. So this is this column here in this case. But what we can clearly say now afterwards, or after seeing the price action, okay, there was some sellers coming into the market when the market dropped below 11,200. Now your question comes into play. You're wondering, okay, why did sellers come into the market? And therefore, we have to have a look at the what's the English word? In German, we call this Auszahlungsprofil. What you can expect. It's not the number or the money you can expect to make, but it doesn't really matter, to be honest. So some of you probably have seen how a long put position looks like. What is a long put position? Long put position aims on to make it rough and not looking at complex strategies here in this context. It aims on ensuring your portfolio. So you're making sure that once the market drops below a certain threshold in a stock you may hold for whatever reason, and you want to hold it for a longer time frame, you want to ensure that even if volatility picks up, that the losses you are facing within your stock or your stock's portfolio in general, that this is insured against those losses with an insurance we call a long put in this case. So, and the level you're looking at here, where you want to say, this is the level I want to, with a break, I want to be insured against if the market drops below that. This is what we call the strike price. So this is the strike, and in our case, let me just do it that way. It's 11,200. So you can also adopt this to the DAX then in this case, not only to stocks. So let me do it that way. Okay, so this is the strike then. Okay, this is this vertical line here. So this is, let me just put it here. This is the long put. So now the thing is, if you're long a put here, there has to be someone who is selling the put to you. And these are usually, let's call them big insurance companies, even though it's market participants, market makers, whatever, selling insurance to you. And their payout in this case, it's the opposite. You have to mirror this, and then you find out that they are obviously hoping that the market does not drop below 11,200 points here in this case, and they are making money. They are making money here if the market closes. That's when the option expires, that it closes above here 11,200 points. Let me just put this here again, 11,200. So that means we call this a short put. And these market participants are those we are looking at here when looking at this, at these numbers, at these columns. So we are not looking at these being long put, but we are looking at these who are currently short put. So, and the more market participants are short, the higher the significance of this level, in this case 11,200 points becomes. Because now the thing is, if there's an external event like the retail sales data yesterday, we'll look at this a little later and give an explanation of why this is of interest. But the interesting thing about this here is that if the market drops below this level, 11,200 points here in this case, once this happens, those market participants being short put here and losing money with this graph here falling on to the lower left. These market participants have to hedge their exposure, and how do they do this? Well, they do it through selling the DAX in this case, who has such a payout here, which then results in a hedge. They are losing with the short put here, sure, but they are making money on the short DAX here in this case. And especially in a thin market environment, this is the moment when there's dynamic coming into the market and the market accelerates on the downside. So this is now the most likely explanation. I mean, big market participants know about this. This data we just looked at is completely free available for everyone. So we can look it up, but everyone else can look it up too. So institutionals, for example. So now my idea is the following. Yesterday, the data acted as a trigger event, which gave a reason, let's say, to sell the DAX, and which forced then market participants out of their current short puts in this case, and accelerating this move on the downside. It was a quite brutal move, to be honest. So if you look at here at this chart, you can see that within minutes here, for example, the DAX dropped 30, 40 points in 5 minutes, which is quite big compared to the volatility we've seen the minutes before, at least. And so when looking at this is a good explanation of what happened yesterday then, in my opinion. Now, the thing is the following. If you squeezed out those market participants being short put here, there's no reason then for the market to stay below that level, because usually once those market participants are hedged, and they are not the only market participants, but those market participants who are trading a high volume, which is probably leading the way for the day. Well, if those market participants don't need to sell the DAX anymore, there's no reason for the selling pressure to persist here. Which means if those sellers step out of the way and the market sees the current fair value of the DAX significantly higher, probably around 11,200 points, the level where yesterday's, let's call it small sell-off here started, well, this is a perfect explanation of why the market then bounces back. Or can bounce back and result in such a short squeeze. It's not that those market participants are reducing their hedge again. Could be if they're very, very aggressive, but all in all, they are hedged, and probably they just say, okay, well, the bet just didn't work out, and so fair enough. Let's wait for another opportunity here based on our strategy. But the thing is that this is, in my opinion, a very good explanation, especially in the thin market environment we're currently in, why the market showed such a push higher than here. So yesterday it was a short a short put squeeze, let's call it. So it was a squeeze of those market participants betting that today at 12 p.m. London, so these options expire at 1 p.m. German time or 12 p.m. London, that this was just initiated here and was a forced move, let's say. And once the selling pressure here came to an end, well, there was no reason to for the market not to bounce back to the current fair value, which is probably be found here around 11,200 points. And so with this in mind, then this move, in my opinion, makes more sense. I mean, it's only speculative if this is really the case. Again, at the end, it's just the case that I'm not positioned in the long move as I should have based on my signal. Again, I'm not short either, not losing money. Nevertheless, it starts to really annoy you if you see such a squeeze higher, because this is usually what you're looking for. No real pullback, market just moving in your direction, going up, and you just need to trail the stop behind the market and turn a nice profit right into the weekend. I mean, this is why we're here, right? And so if this really happened, then okay, I think it's a good explanation, even though I hadn't it on my agenda. The second thing is we don't really know if it's true or not, but in my opinion, it makes the most sense to look at it from this perspective. So I referred several times now to the retail sales. The question we want to answer, surely, for the upcoming week of trading is, so what can we expect to happen? And first of all, we have to have a look here at a chart. It's from Bloomberg here in this case. And so what we can see is that the retail sales yesterday unexpectedly fell 1.2% in December, which marks the biggest drop since September 2009. I already mentioned this. So all in all, this is not a big surprise, or not a big surprise, it's the wrong word. It's not a big deal since it's only one data set. And to be honest, I mean, it's not changing the overall skepticism, let's say, around fears of the US dropping into a recession, for example. I think this didn't really happen yesterday. Nevertheless, I mean, the market just moved higher, in my opinion, still on a manipulation, especially from the White House, which brought in person of Steven Mnuchin, the U.S. Treasury, the plunge protection to be honest, for no real reason here, after we've seen a very, very volatile and sharp drop in this case to new yearly lows of the S&P then in the fourth quarter of 2018. Sure, there was also, or we should definitely also look over to the Fed here and their communication, not only in terms of rate hikes. Remember, at the beginning of October, they were talking about being quite significantly below the neutral rate here, which indicated that there will be more rate hikes to come then in 2019. Markets were expecting at least 3, probably even 4. Right now, we're not expecting 1. So we're right here at 225 basis points, which means that we are right now expecting cuts instead of hikes. And then there was also the communication from the Fed at the December meeting where they said that the balance sheet runoff here runs on autopilot, which was also taken by market participants as a sign that probably we shouldn't expect the Fed to step in if the markets see a more significant corrective move here, which means all in all that this also added here to the selling pressure. On top of that, the White House, nevertheless, with Donald Trump, delivered enough reason to be very skeptical about the overall economic outlook, global economic outlook, due to the trade war fears. So it was a combination of everything. And then the U.S. Treasury, Mnuchin, stepped in and talked about the plunge protection team. That was between Christmas and New Year's Eve. And it resulted in such a short push higher. Plus, on top of that, there was also the communication then from Powell. Right now, it's not only that no rate hikes are expected anymore, but it's also that now the Fed is flexible in terms of the balance sheet runoff. So the combination of that is the reason for this. Yeah, it's a V correction right now, even though from a fundamental perspective, nothing really changed. So yesterday's data around retail sales fuels fears around a recession hitting the US rather sooner than later. So, and with this in mind, I think this is giving a very good explanation why yesterday's data set matters. It also becomes clear, and this is also adding to my quite strong rhetoric, I have to say, here in terms of the manipulation we are currently seeing. I mean, the U.S. Or the White House Chief Economic Advisor, Kudlow, yesterday, he said that there was a glitch in the data, so which is, to be honest, it's ridiculous to call a data set here being a glitch. It's the same rhetoric being used by Donald Trump here in regards to this sharp drop in U.S. equities. Was also a glitch, and everyone blamed HFTs and everyone blamed high frequency trading here in this case, and everyone blamed algos who were responsible for this sharp drop. And right now we're seeing the S&P trading nearly 20%. So more than 400 points higher from the lows here. The fundamental picture did not change one bit. Instead, we've seen, for example, the retail sales data pointing really to a slowdown from an economic perspective. We have to remember that retail sales are the backbone of the U.S. economy here, and so no one is talking about glitches or blaming HFTs or algos for this V corrective move higher when the Dow Jones is making I don't know, 500 to 1,000 points in one day, and on nearly no volume. The market just drifting higher here, and it's manipulated in this case. So I think we can use this word here in this context. So it perfectly illustrates these words from Kudlow yesterday. The glitch in the numbers, or also saying that it was due to the shutdown. Was it really due to the shutdown? I mean, the U.S. shutdown was mainly in January, I think. It started shortly before Christmas. Which means the numbers yesterday, retail sales came in for December. Why is he talking about the retail sales coming in worse than expected due to a shutdown which took place 1 month later? So this is, it's perfectly illustrating, I think, that there's right now a very, very difficult situation, and that the move here in equities is a very fragile move. So, and yeah, that said, I have to admit that I'm really skeptical right here. If we can continue to trade higher, even though we stay very skeptical about short engagements too. And this is the main reason for that is, well, if the market is really manipulated higher, what we really need is a risk off driver, aggressive risk off driver, which pushes the equity markets lower. And so as long as we do not have this, we shouldn't stand in the way of a Fed in this case, but also of a plunge protection team, which is obviously trying to hold the market to a certain level here. Sure, we have to wait in case of the S&P if we can really make it back above here, this 200 simple moving average. We have to really wait. If we can reconquer it and break back above 2,760 points, a push up to 2,800 here, 820. These highs from December, respectively, also from November, are an option. And nevertheless, what you also should remember is this is also needing a driver, which we not necessarily get to see over the next week, since there's, for example, no clear solution right now on the agenda in terms of the US and Chinese trade war and the negotiations here. I think next week there will be talks in Washington. So the talks in Beijing, which took place over the last days, didn't solve any problems. And the only positive thing right now is that the deadline, which was given by the White House here to find a solution till the 1st of March, will be probably extended. And then Donald Trump and Xi Jinping, the Chinese prime minister, will meet here in March, somewhere in the first 2 weeks, if I'm not mistaken. But till we do not have a solution here, we should be really careful. On one hand, with long engagements, which become, due to this V-corrective move here, not so attractive anymore from a risk-reward perspective. On the other hand, we should also be careful with short engagements, since for a sharper drop on the downside, we definitely need a risk-off driver, which currently isn't found. Nevertheless, the thing is, so what we could see here, by the way, is that the DAX now pushed above 11,200 points. So now going into probably another squeeze, but I'm very skeptical about this intraday move here too. And the reason for that is, first of all, if we look at the dollar JPY, so dollar JPY, it's not as that the JPY is really aggressively outperforming the US dollar, but nevertheless, you can also see that it has traded into dollar JPY in this case, has traded in the red territory here for quite a while. It's a very volatile market environment, but usually what you expect in a really risk-on market environment, and when looking at right now in the DAX and seeing such a sharp push higher of nearly 200 points, usually if this is a risk-on move, you usually see the JPY being sold, and this is not happening. So yes, we are red now for the day. Nevertheless, the thing is that the JPY still looks very solid in this market environment. On top of that, when looking at gold, for example, what you can also see here is that gold is clearly green for the day. And by the way, in this context, definitely makes sense to have a look here at the website from Admiral Markets. 1 second, please. So here I've prepared the economic calendar. So this is to be found here below Analytics and Traders block. Click on the Traders block, and while we wait for this website to open here, I also opened the news tab. It's about us and their news, and there you have the trading hour schedule for the US President's Day. I think this is very important here to give you US President's Day trading hours. So this is the first one, so we can close this, and then the traders block. It here it's I'm painting a quite bullish outlook here. for gold. Unfortunately, we didn't make it to the preferred long trigger around 1,295 to 1,299 USD here. So unfortunately, we didn't make it to this level. But nevertheless, if you read this piece here, and also I'll give the link here into the chat box. I just call it gold. You can read such a piece here every Monday, Wednesday, and Friday, by the way. So you can find it then via the Traders block, Analytics and Traders block. It's right below the Forex calendar here. And so I'm painting a very, very positive picture for gold. The reason for that is from a retail sales perspective, again, it was only just one data set, but it's definitely fueling speculations around skepticism of the U.S. economy, and then we also have still fears around the U.S. and China not finding a deal. So all in all, we can sum it up. I mean, Donald Trump said several times that he is confident that they will find a solution, and everything fine. The only problem is if it was so easy to find a solution between those two parties, well, I think they would have already found a solution, but they haven't. And this indicates that obviously there is some harsh and hard fights going on behind closed doors, which means we still have a solid chance not to get to see a deal at all, which means nothing more than if the US and China do not present a deal within, let's say, the next 4 weeks, this could add to market participants becoming very, very anxious, very nervous again. And this is usually a market environment in which gold performs extraordinarily well. Plus on top of those recession fears from the US in general, which means that it's not a target, an intraday target, but for the days to come, we have a serious chance that if we break back above 1,330, the current yearly highs, the January highs, if we break above that level, there are further gains likely, which will push us then up to the 2017, 2018 highs around 1,360 USD per ounce, in my opinion. So this means the outlook for gold is very positive, and also the performance today from gold, in my opinion, it's a sign that here, this move in the DAX, even though it looks very, very strong, should be watched carefully. And I wouldn't be surprised if, not necessarily today, I think this mainly depends on the US equity markets, how they perform, but nevertheless, that this move is probably sold again rather sooner than later. And this is, by the way, true, in my opinion, as long as we do not make it above the current weekly highs, which were marked, by the way, yesterday too, around 11,260 USD around, points around. If we make it above that level, sure, then we have further room up to 11,390. And when looking at the daily chart, then at the bigger time frame, you can also see that then further gains are likely to be seen, which will push up to the December highs, to be found between 11,550, 11,600 points. But all in all, you should be really, really careful. First of all, the JPY doesn't really look like weak in this market environment. And on top of that, gold is also looking very strong, which is usually not an indication for risk on move. But this is probably mainly liquidity driven, and due to a thin market environment where we see an acceleration and domino effect on the upside, the squeeze, and not a real sustainable move, in my opinion, but shorts probably taken out, which built short positions yesterday here. And again, which is probably driven by the small expiration, which took place around 45 minutes ago, so at 1 p.m. German time in this case. So yeah, that's it on the DAX, on the gold, on dollar JPY. Probably finally, let's have a look here at pound sterling against the US dollar. In my opinion, very interesting, because we've not only seen a retest of this trend line here, which could act, in my opinion, as a potential long trigger. So there you can see it. So it's, in my opinion, quite significant region, and we've seen this push to this region here. And by the way, I'm sorry, this is not right. It's 2750 to 2770. so slightly below that level. And so first of all, this is from a technical perspective, an interesting level to look for, or a level which I already mentioned here over the last days here on Monday and on Wednesday on a technical piece. And now the interesting thing is that today's retail sales data came in significantly better than expected. And so with my skepticism around the US dollar, I'm not very positive for the US dollar based on this data set. Again, it's only one data set. Nevertheless, it could fuel some US dollar aversion, let's say, over the next days. And this could lead to another wave of selling of the US dollar, which would then also lift GBP, pound sterling higher. And this is especially true. I mean, Monday is a bank holiday in the US, President's Day, okay, but on Tuesday, the economic docket is very, very packed for pound sterling in this case, with employment numbers coming out. And if after the retail sales data today, the employment situation surprises on the upside, in combination with the technical relevance of this region, a push higher here and a push back over the next days to come then to 129.50, 130 is definitely an option. So I think with this push higher here, and as long as we trade above 127.50 to 127.70, a push higher in pound sterling against the US dollar seems very, very likely. So, and that's it around the markets for the next week. I wish you a nice weekend. Enjoy yourself. If you have any questions, please feel free to send them via email. And yeah, have a nice weekend. Happy trading. Watch your stops. Talk to you again next week with the weekly market outlook from Admiral Markets. I definitely look forward to it. Have a nice day. Have a nice weekend. See you and bye-bye.